few more people logging in. Good morning, everyone, and welcome to today's webinar. I am Chris McCauley, Benefits Attorney at ProBenefits, and I'm joined today by Charles Crabb, a Benefits Consultant at ProBenefits. Today is the webinar in our ProBenefits Client Webinar Series for 2015. Today's webinar is an update on Section 125 plans, pre-tax benefits, and FSAs. As always, for everyone in attendance and everyone that registered, a copy of the slides and recording will be emailed to you following the completion of today's presentation. We welcome questions from you. On the right side of your screen is the control panel. You can submit questions using the control panel. We will do our best to get to the questions during the presentation, and we may respond to some in writing throughout the presentation as well. In December, we will have our final webinar for 2015. It will be an end-of-the-year checklist for 2015 and a look ahead to compliance in 2016. But everyone will get a formal invitation for that presentation closer to the dates. Today's session, we're going to talk about just a refresher on what Section 125 plans are and how they can benefit employers and employees. We're going to talk about a few recent developments affecting the 125 plans, and then a couple of trends we're seeing in terms of Section 125 plans, and then we will, of course, answer your questions as they come in. So with that, I'm going to turn it over to Charles to begin the presentation.
Thank you, Chris. Just very quickly to start with, we'll just kind of go over just a quick review of what a 125 plan is. And basically what the purpose is. And it's basically a qualified tax plan supported by Section 125 of the tax code. It goes by a lot of different names. You'll hear it called Section 125 plans, cafeteria plans, flex plans, all the same, however. Goes by different names, but all the same plan. They're all considered Section 125 plans. The purpose of the employer-sponsored 125 plan is to allow employees to pay for certain eligible benefits with pre-tax dollars as opposed to with after-tax dollars. As we're all familiar with our paychecks, we start with gross pay and then they withhold various payroll taxes, usually federal, state, and FICA. What this plan allows employees to do is make any contributions or payments to eligible benefits pre-tax or before payroll taxes. Typically, that can be anywhere from 20 to 30% savings in payroll taxes if these contributions are run through a 125 plan. In addition, the employer is required to pay a matching FICA payroll tax for every taxable dollar paid. The money run through the Section 125 plan is exempt from the employer FICA match. So the employer is also going to save in some of their payroll taxes 7.65% in the matching FICA payroll tax. So it's a win-win. Section 125 plan is a win-win for both the employee and the employer. Now there are lots of different variations of Section 125 plans, but the two basic types of Section 125 plans are what we call a premium-only plan or POP plan, which covers or provides employees the option of paying for eligible group benefits, their share of the premium cost pre-tax. So that's your basic premium-only plan or POP plan. In addition to that, FSAs is an additional component, flexible spending accounts. One thing I have lots of conversations about with employers and brokers is I need a POP plan and I need an FSA plan. In reality, those are just components of the same plan, a Section 125 plan. So a Section 125 plan can have various components or variations. Those are the two basic types of plans, just the simple premium only. If you have the FSA, usually it includes both the pre-tax premium or POP portion and the FSAs, but it's all one plan under Section 125. All right, Jason, if you want to, there you go. Just to cover a few eligible benefits that can be covered by your Section 125 plan. Obviously, group health insurance, dental insurance, vision insurance are all eligible group benefits that can be set up under your Section 125 plan. Term life is also eligible, at least up to $50,000 of term life. Any amount over the $50,000 cannot be paid for under 125 pre-tax. And that includes, just a note here, that includes the employer provided plus any additional purchase by the employee. The combination of employer and employee provided term life up to $50,000 is eligible to be run through the 125 plan. The accident coverage, disability policies, you'll notice an asterisk beside the disability, long-term and short-term. That's there for the simple reason that if disability is purchased and paid for pre-tax through the 125 plan, then the benefit, if and when it's ever paid out, the disability payments would then be considered taxable income. So oftentimes we recommend that disability policies not be a part of the 125 plan, that those be purchased outside of the 125 plan on a post-tax basis, so that if and when those benefits were paid out, it would be tax-free. So if you paid for disability policies pre-tax, the benefit is taxable. If you pay for the disability policies after tax or post-tax, then those benefits would be tax-free. That's the reason for the asterisks. In addition, you can have FSAs or flexible spending accounts under 125 plan. There are two types of FSAs, health FSAs, which is money that employees can put aside tax-free for out-of-pocket medical, dental, and vision expenses. There's also the dependent care FSA, or it's also known as child care FSA, and it's for work-related child care expenses. So you can put money aside tax-free for those work-related child care expenses. HSA contributions can be run through the 125 plan, and we'll talk a little bit more about that in the next slide. But many of your supplemental products also are eligible, like cancer, critical illness, and other supplemental products. So let's talk a little bit about HSAs in the next slide. Oftentimes I'll get the question, health savings accounts, it's not really an employer-sponsored benefit. It's an actual bank account where participants can put money in tax-free for their out-of-pocket medical, dental, vision expenses. So can I make those contributions through a Section 125 plan pre-tax? And the answer is yes. Both employee and employer contributions to the HSA bank accounts can be made pre-tax, and we strongly recommend, or often recommend, that you do that through a Section 125 plan, because employer contributions made outside of a 125 plan have to comply with some strict comparability rules. Now, employer comparability rules with regard to employer contributions are pretty complex. It's a whole nother webinar, so we won't get into that, but just know that yes, HSA contributions can be made through the 125 plan, and that's actually the preferred method, so that the employer contributions don't have to meet those comparability rules. Now, HSA contributions are limited. Yes, the 2016 limits for employee only is $33.50, and for family coverage $67.50. Those limits are the total of both employer and employee contributions. Your Section 125 plan needs to include the HSA contribution as an eligible benefit in the SPD and the legal plan documents. And you'll also know that lots of employees or individuals are not eligible to participate in a 125 plan, and we're not going to cover that in detail in this particular webinar, but just make a note that self-employed individuals, that would be owners of S-Corp, LLC, partnerships, etc., are not eligible to participate in a 125 plan because they're considered self-employed. and they're not actual employees. So how do they make contributions to their HSA? Well, they can't do it through the 125 plan because they're not eligible to participate in the 125 plan, but they can still make contributions to their HSA with post-tax dollars, and then when filing their individual income tax forms, they can take the line item deduction. Now they'll lose out on the FICA savings, but they'll get the federal and state line item deductions. All right, I'm going to turn it back over to Chris, who will give us some compliance updates, recent compliance updates on Section 125 plans.
Thanks, Charles. And before I get to my my slides, I wanted to make a couple points. First, back to your point about the pre-tax premiums and FSA being one plan, that goes for the plan documents as well. The pre-tax premium portion of the plan and the FSA, they're combined in the same plan document in SPD. Often we get a question, we'll send out some plan documents and we'll get a response, thank you for the FSA SPD, are you going to send the pre-tax premium SPD? But they're all combined. So if you go through and read the SPD, you will see there's a pre-tax premium section and also an FSA section as well. And one other thing I'd like to do, maybe if we can go back a couple slides to the increasing tax savings slides. As Charles pointed out, these are all benefits that can be pre-taxed, but they don't need to be pre-taxed. The employer could require employees to pay for these on a post-tax basis. And one thing to note is that when benefits are being pre-taxed under a 125 plan, there are certain along with it, and we didn't have a slide on these issues in this particular presentation. But what I wanted to say is one of the rules is the irrevocability rule, which basically says if you are going to pre-tax benefits, then your election for the year is irrevocable throughout the whole year. So you can't make a mid-year change unless you have a qualifying event. And I think many of us are comfortable with the fact that health, dental, vision, you need a qualifying event to make a mid-year election change. But I just wanted to point it out that those qualifying event rules and the irrevocability rule applies to all of the benefits listed here if they're being pre-taxed, with the exception of the HSA bank account contributions. So if someone elects short-term disability for the year, then that election needs to stay in place unless they have a qualifying event. And that might be of note for an employer that is adding some of these ancillary benefits. Perhaps you want to add a disability plan. You don't know if employees are really going to want to be on the plan, but they want to try it out. And after three months, maybe they don't like the plan or want to stop deductions. Well, just like the health plan, the rule is that election should stay in place unless there is a qualifying event. So I just wanted to point out the irrevocability rule and how it applies to these pre-tax benefits. Moving on to my updates, and these are a couple of developments that we've been tracking for the last couple of years now. I think we're pretty comfortable where we stand in terms of same-sex spouse coverage. After the Windsor decision from the Supreme Court a couple years ago, and then Obergefell earlier this year, we're pretty comfortable with the fact that employees, in terms of the tax treatment of the benefits, same-sex spouses should be treated the same as opposite-sex spouses in terms of the tax treatment of benefits. What that means is if an employee has a same-sex spouse, the spouse's premiums can now be withheld pre-tax under a 125 plan, and any expenses can be reimbursed from the employee's FSA. So same-sex spouses are now covered by the employee's FSA. Sometimes we still get some questions about eligibility for benefits, whether an employer can discriminate against same-sex spouses. Perhaps they've always offered coverage only to opposite-sex spouses. They still would like to do that moving forward. There really hasn't been any affirmative action from the government that says we must cover that employers must cover same-sex spouses. However, there have been a number of recent judicial and agency developments which suggest there are some potential legal issues if we discriminate against same-sex spouses. So I think the recommendation is to treat everybody the same. Same-sex spouses, in terms of eligibility for benefits, should be treated the same as opposite-sex spouses. And if you are considering excluding same-sex spouses, we really recommend that you consult legal counsel before doing so, because again, I think there are some potential legal issues out there. Another development that we've been tracking is the federal marketplace, the federal exchange, and the qualifying events that are now permitted for enrollment in the marketplace. And this really applies to fiscal year plans, non-calendar year plans. So open enrollment in the marketplace for health insurance through the marketplace is going on. It began November 1st and it goes through January 31st. And what the new section 125 qualifying event says is that an employee, if they're covered under the medical plan, but they want to get coverage under the marketplace, if they enroll in marketplace coverage, that they can go ahead and drop their group coverage mid-year. So this solves what was an election lock problem we had for maybe a year or two, where an employee was enrolled on the group plan that began June 1st, but then they wanted to enroll on the marketplace during marketplace open enrollment. Well, going back to the irrevocability rule and the qualifying event issue, there was no qualifying event that would allow the employee to drop coverage under the group plan to go on the marketplace plan. There was no qualifying event originally. Well, the IRS last year changed that, so now there is that qualifying event which allows employees to make that change if they want to go on to the marketplace. A couple of issues that may impact the flexible spending account, the FSA Max. First, a couple of weeks ago we learned what the FSA Max will be for 2016, and it's going to remain $2,550, and that FSA Max is for employee contributions to the FSA. The Affordable Care Act, healthcare reform, imposed a $2,500 maximum for the FSA a couple of years ago. That maximum can be indexed for cost of living adjustments, and it was indexed last year. So for 2015, it went up from $2,500 to $2,550, and we just learned a couple weeks ago that that's where it's going to stay again for 2016. So the FSA max for employee contributions will be $2,550 again in 2016. There are a couple of other ACA implications for FSA. Some have really already been implemented, and some maybe one of these may be looking ahead. But the ACA, just like for medical plans, has increased the age of coverage that we can cover pre-tax dependents pre-tax up to age 26. So it really has expanded the definition of who can be covered pre-tax. Under the FSA. It used to be mostly tax dependents, but now that has expanded to all children of the employee until through the end of the plan year that they turn 26. So that was one positive benefit for FSAs. Over-the-counter drugs and medicines, as you probably know, now must be prescribed by a physician in order to be reimbursed. That did come from the ACA. PCOR and reinsurance fees, which apply to many health plans, PCOR, which also applies to HRAs, those fees that stem from the ACA do not apply to the FSA. So if you have a flexible spending account, these fees are not something that you need to worry about. Finally, the Cadillac tax, which could potentially come into play in 2018, which is the tax on high cost of health coverage. The FSA contributions, either employee or employer, could count towards the cost of the coverage for Cadillac tax purposes and impact whether an employer is subject to the Cadillac tax, but it's still up in the air whether the Cadillac tax will actually go into effect. I know there's a lot of efforts in Washington to try to repeal the Cadillac tax, and I even know at least one leading presidential candidate, Hillary Clinton, has come out in favor of repealing the Cadillac tax. So that's something to consider moving forward. And with that, Charles, I'll go ahead and pass it back to you.
Okay. Thank you, Chris. One thing we wanted to just kind of give a quick review on, and this is a variation of a Section 125 plan design, is employer flex credits or benefit credits. Again, this is all still variation of the same theme of Section 125 plan, but there's multiple ways to design a plan and how the cost of benefits is displayed or presented to the employees. And I just wanted to give you just a few ideas or thoughts about some things that employers can use, or tools they can use that provide some flexibility for them as employers and for the employees. So just a couple of them I just wanted to touch on, just to refresh and review and remind folks these options are available. I would be more than happy to talk to anyone specifically about a particular situation or client where they might want to try to implement some of these variations or plan design options. One is called a seed contribution, and that's pretty much a match where if an employee elects to make a contribution to one of the eligible benefits, such as an FSA or even an HSA through the 125 plan, then the employer, that triggers an automatic contribution from the employer into that benefit. So for example, a $250 FSA contribution from the employer is triggered when an employee makes an election into the FSA. Another is what we'd call a matching contribution, similar idea here, where you match dollar for dollar up to a maximum amount. So if I put $500 in my FSA, my employer will add an additional $500 to my FSA. So that would be a matching contribution. Another option or idea is what's called a defined contribution or a flex contribution, where the employer says, here is the bucket or define a dollar amount we're going to spend to provide benefits or help pay for benefits for our employees. Then the employees take that bucket of money or that defined contribution and go shopping on a list of eligible benefits that they can purchase with that employer contribution or credit. So that's the term cafeteria plan is used oftentimes to describe this defined contribution type design option. Another option is what's called a waiver credit. Again, this might be used to incentivize employees maybe not to enroll in benefits if they're covered somewhere else or have benefits somewhere else. So if you waive out of a certain benefit option, then the employer would provide cash out, say of $500 for anybody that waives enrollment in the, say, group medical plan. And that would just sort of incentivize folks not to be double covered or to have benefits they don't really need. So again, these are just some ideas, and these tools or plan design options can be used in combination, or, you know, it's not just either or. But these get somewhat complicated and complex, but I'd be happy to talk with anybody about how you could use some of these more complex design options to design a 125 plan to create certain incentives or to control certain costs for benefits.
Charles, one question submitted. Can an employer use flex credits or defined contribution credits to allow an employee to fund an individual health insurance plan or a marketplace health insurance plan?
And the answer would be no, at least not directly. You certainly could have a cash out or a waiver credit where then that turns into cashable income or taxable salary, and then obviously an employee can use their taxable salary for whatever purpose they want. You know, buy groceries, pay the cable bill, or buy an individual insurance policy, but it couldn't be done on a tax-free basis. So in order to you know, get funds to employees to purchase individual marketplace insurance, it would have to be done through taxable wages. So there's where the waiver credit would come into play. hey, if you don't purchase our group benefits, then we give you a cash out taxable wages, and it's just added to your gross wages. Does that very well cover or answer the question, you think? Or
Yes.
feel free to jump in. Okay.
Yeah.
All right, next slide. I wanted to also just make mention of a short plan years. Typically, 125 plans run on a 12-month plan year basis. It could be calendar year or it could be fiscal year. So where might the short plan year be valuable or useful? The question we get is, should my 125 plan align with my group benefit renewals? And the answer is yes. Chris alluded to this earlier in the presentation, that a Section 125 plan, when employees enroll in these group benefits that are listed under the 125 plan, then not only are they making an election in, say, the medical insurance or dental insurance or vision insurance, that is an election, and they're enrolling in that benefit. At the same time, they're enrolling in the 125 plan to pay for those benefits pre-tax. So that's a 125 plan election. Chris mentioned the irrevocability of that election. So it's pretty important for compliance reasons to have your 125 plan run concurrent with your benefit open enrollments. And we also understand that, and it's oftentimes impossible to get all group benefits aligned to have a single open enrollment, whether it's January 1st or some other fiscal plan year. And we can certainly make accommodations for that in the 125 plan documents, but it does need to be addressed in the 125 plan documents if you have, say, medical, dental, and vision all enrolling at different times. But the bottom line is you really should try to get your 125 plan open enrollment in line with or running concurrent, especially with your group medical insurance. And there's a couple of reasons for that, just some practical reasons. Oftentimes at the medical insurance open enrollment, employers may add an additional option or move to the high deductible health plan option with HSAs. Well, if your FSA plan under the 125 plan has been running calendar, but your medical plan is renewing, say, July 1st, and you want to move everybody to a high deductible health plan, well, you're in the middle of a calendar FSA plan, and there's really no clean way to terminate that plan mid-year. So no one would be eligible to open up their HSA accounts until the following calendar year because you're in the middle of a calendar year FSA. So just for some practical reasons, it's a good idea to have your 125 plan running concurrent with your medical plan. So when you make changes to your medical plan options, folks can move from an FSA to HSA, or just a more basic idea is it's a good time to make your FSA election when you're looking at your new medical plan copays and deductibles and coinsurance and out-of-pocket amounts. Those tend to change each year at open enrollment. Well, that's a perfect time for me to decide how much I need to put into my FSA. So we oftentimes recommend that folks, in order to get their 125 plan in line with their other group benefit renewals, run a short plan year. So if the 125 plan has been running calendar, then we can run a short year, say from January 1st to the end of June, then have the 125 plan from there going forward renew on a 7/1 fiscal year, for example, to run concurrent with your other group benefits.
Charles, follow-up question on that. If an employer does use a short plan year to align benefits, what about the FSA max? Could the employees still use the 2550 max or whatever the employer's max is, or would they be limited for the short plan year?
Mm-hmm. Yeah. My understanding, and Chris, you can jump in on this, and I know maybe that's the different FSAs have different rules about the maximum. My understanding is you need to prorate the annual plan year maximum. So the 2550 needs to be prorated and we would recommend the child care FSA, the $5,000, be prorated. Chris, do you have anything to add to that for prorated maximums?
Yeah, that's exactly right. If the employer is having a planned short plan year, so at the beginning of the plan year they decide to have a 6-month plan year, then yes, the FSA maximum for that plan year would have to be prorated. Essentially, it would be 1/2 of the maximum. That rule is slightly different than the rule for employees that enter a plan mid-year. So if the FSA is a full plan year, but an employee is hired halfway through the plan year, then that employee could elect the full maximum FSA. But if the plan has a scheduled short plan year at the beginning of the plan year, then yes, the FSA max should be prorated.
Thank you, Chris. Appreciate that. All right, and just basically the last slide here, just to sort of review ProBenefits and our 125 administration. Yes, honestly, 125 plans can be self-administered by employers, but we highly discourage that because of the complexity and compliance issues. So it's probably a good idea to find a third party or someone to help you administer these plans. And with ProBenefits, our administration is complete administration. So as Chris alluded to earlier, when we send out the legal documents for the Section 125 plan that we're administering, it includes both the POP or pre-tax premium portion and the FSA components. One plan covers both. Our FSA administration includes direct deposit, flex cards, but not only are we doing the claims administration on the FSA, our 125 administration covers the compliance piece. So these 125 plans are more than just setting payroll up and to be pre-taxed or reimbursing through the FSAs, doing the claims adjudication. There is a compliance component to these plans. There's discrimination testing. There are ERISA, SVD, or plan legal documents that are required. Our administration includes all of that. With regard to customer service, the employer has a single point of contact, so a ProBenefits administrator is assigned to each client to handle all aspects of plan administration. So you're not having to call and talk to 20 different people to get any type of issue resolved. You've got a single point of contact. We have a dedicated website for employers and employees to manage and access all plan transactions and details. And again, we have two benefits attorneys on staff, Chris and Jason, who you've heard from already during this webinar presentation, that assist with all the compliance and technical support of all of our Section 125 plans for our clients. And Chris, I'll turn it over to you to kind of wrap things up for us.
Yeah, just another point in terms of the support we have. As we talked about, there are the 125 plans and pre-tax benefits have rules that go along with them, and we've talked about them in other presentations. But we do have support here. We get qualifying event questions all the time that we're able to assist employers with. For example, an employee's spouse loses their job, can they add medical coverage, can they drop medical coverage, those types of questions. And who's eligible for pre-tax premiums, are owners eligible, those types of questions, compliance questions we get all the time, and that's something we have a lot of experience with and a lot of support for employers out there. There's another question that has been submitted. This goes back to the defined contribution question. If an employee doesn't elect to use the entire amount allocated, can they cash out the remainder as a taxable benefit added to their salary? And again, this goes back to employer flexibility. These are employer dollars going into the 125 plan. So within a few broad rules, the employer can pretty much dictate how these credits are used. So there are certainly employers out there that say you get $1,000 to use for benefit options. If you don't use the full $1,000, then you forfeit any remaining money. That is one option. There are employers out there that say you get $1,000 if you don't use it all for for the benefits that are being offered, then you can take the rest home as cash. So again, this goes back to the credits and employer flexibility, and the employer has the discretion in a lot of these contribution issues. With that, I think we're going to go ahead and end the audio portion of the presentation. We will stick around and try to answer any additional questions by writing, if any are submitted. We'll stick around for a couple minutes, so if you haven't submitted a question but have a question, go ahead and feel free to submit it to us. After the webinar, if you have any questions, you can always submit them to me directly by email, christopher@probenefits.com. Again, look out for December's webinar. There should be an invitation coming a few weeks before that presentation. That will be the final one for 2015. I hope everyone has a good Thanksgiving week, and as we move closer and start to prepare for 2016, I guess we'll get to that after Thanksgiving. So again, everyone have a good day. Bye-bye.